A number of Fed officials speaking yesterday afternoon about interest rates and what may happen when central bankers meet in March. Steve Leisman joins us right now with more on that. And things got pretty interesting, Steve.
Yeah, they sure have, Becky. Treasury yields rising this morning in the wake of that hotter than expected wholesale price report. We got low jobless claims and the hawkish talk from two Fed officials suggesting they could support a 50 basis point rate hike at the March meeting. Both Cleveland Fed President Loretta Mester and St. Louis Fed President Jim Bullard said they supported a half-point hike at the February meeting and wouldn't rule one out at the upcoming March meeting. The effect in the Fed funds futures market has been to move the pricing for the peak funds rate to a new high of 532. I guess that's where it is right now for the August contract, and to bring the year-end pricing directly in line with the Fed's own average forecast of 513. The two-year yield also surged this week from around 450 to 470 as it digests this recent economic data and Fed talk. Neither Mester nor Bullard are voters this year. They've been replaced by somewhat more middle-of-the-road Fed presidents. Harker of Philly and Logan of Dallas, to my knowledge, have not indicated support for a 50 explicitly. New Chicago Fed President Austin Goolbe, he's a bit unknown in this regard. But Neil Kashkari of Minneapolis, right here on Squawk Box 10 days ago, he revealed himself to be among the more hawkish FOMC members, supporting a 540 year-end rate. The comments of Mester and Bullard show there is not unanimous support on the Federal Open Market Committee for the move away from what we call front-end loading rate hikes and instead responding to economic data through quarter-point hikes. The market continues to price in, though, for the March meeting a quarter point. I think that's the most likely bet right now. Minutes next week of the Fed's meeting are going to show how much support there is or there was for a 50 basis point hike. And we have upcoming jobs and inflation data before the next meeting. It's ultimately going to determine what the Fed does in March. Now, just real quick, Becky, you know, we've been tracking this divergence between the equity and the bond market. I just want to lay on you where we're at right now. We are up 78 basis points from the January 18th low on the year-end funds contract. And the market is up 3.5%. The S&P up 3.5%. It was 6% a few days ago. Obviously, we've had a sell-off, but it still remains high. And there's a note here, and I thank Scott Wapner for this, from a J.P. Morgan analyst who said that given the move in the 2-year, the NASDAQ should be off 10 to 15%, given that move in yields.